Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. I've often mentioned how the bright green highlighted August 2022 to date uptrend, currently at 1916, how it did not act so much as a support or a resistance, but more of a nuisance. 7 weeks ago, this broken bright green uptrend, along with a darker green highlighted short medium moving average, currently at 1888, managed to erode the bullish incentive enough at the time that they allowed a small bearish downtrend to show the recent bearish angle of attack until 4 weeks ago. It was at that time that I opined that we might be undergoing a change of heart when I said, talking about the market, and I quote, "For the moment, we are still exhibiting lower highs, a keen bearish sign, but the lower lows have sort of petered out, and we seem to have some support at and just under the 21st century absolute Fibonacci line at 1809. This support has been tested on and off since mid-May, and the room for maneuver is now so tight that either the support will have to break or an upper time." And that's the end of the quote. We've since had a changing gap move higher 3 weeks ago over the green short medium moving average, as well as the mauve medium moving average, currently 1896, and the broken bright green uptrend. The rise was just short of the March 2023 low at 2004, where we've seen a rejection there late 3 weeks ago, which, to be honest, looked like long liquidation ahead of the long weekend in the US, but which since has seen a small resurgence in the bearish incentive, though so far it is not excessive. Now, I did put out there some 7 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern was and is not complete, or even giving a clue as to the direction of its validity. I have stated here over recent weeks that we would need to see how the action develops over the next few weeks, and I still stand by this point. I was very clear on the wording of this point 7 weeks ago when I said, and I quote, "Please note, this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. This does not take away from the far smaller August-based double bottom, which saw its topside fulfilled during late August and early September. However, since then prices have drifted lower, though not excessively or even directionally, as we are today higher than we were last Monday. Ice Europe white sugar in London. Many weeks ago I drew a start of April to start of July bearish Andrews pitchfork, which I've since 2 weeks ago indeed finessed to the current green highlighted bearish shift pitchfork you see on my daily chart, hoping with justification, I believe, that this bearish pitchfork might provide an idea of the recent bearish angle of attack. When looking at the action over recent months, I wish to emphasize once again the monthly key reversal down in July, which saw some activity in the downward direction until about 4 weeks ago. However, it has been limited. So back to the bearish shift pitchfork, and I noted some 5 weeks ago a new pattern within a pattern, like a Russian doll. This new pattern was the bright red bear channel you can see highlighted on my daily chart. At a turn of 4 weeks into 3 weeks ago, prices punched up through the top of this bear channel, giving some opportunities on the top side. Primary target would be in the 560.90 area, with a secondary target X swap up in the 599 area. The high 2 weeks ago of 559.30 came awfully close enough to register as having reached target X, but I chose last week to still leave it on my daily chart for definition. Well, since then prices have turned lower, pushed down by the combination of the March 2017 high, 548.70, the green upper time currently 542.30, the mauve medium moving average currently 546.40, and even the green short medium moving average currently 536.5. Prices were low enough now that I have been considering retiring both target X and target X1. Plus, we saw the market fill in the changeover gap, 526 even to 533 even, and at the same time make a new gap lower over this weekend. I said last week about this filling in, I know it's a changeover gap, but it still is, I said last week about this filling in, and I quote, if the market does try and do that, then look below at the congestion 506.40 to 517.80 dating from early 2017 to last month. Then look below at the containing the October 2022 low at 514.5 and the September 2022 low at 517.80. All this before we even start looking at the green middle time below, and that's currently at 490.10. And that's the end of the quote. Well, today we are down there fondling the outer regions of the congestion zone, but seemingly wary of actually testing it. All this despite the weekly key reversal up we saw last week. So you can see there's a lot of pressure on the downside, even when the market makes an obvious and unmistakable attempt to relieve the bearish pressure. Sugar white premium spread. 22 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting there. For the last 8 to 10 weeks or so, the market had been testing the lows of early to mid-October last year, down in a 115.75 to 116 zone. I also noted that though we have been held up here for a while, the support may not be as strong as seen back in October 2023, and this has proved to be the case. Last week the market made a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern, punching down through this 115.75 to 116 zone, and down through the next congestion zone made up of the lesser Fibonacci lines at 107.75 and 104.5, to new lows not seen since February 2023. I said about the supports below last week, and I quote, there are lesser Fibonacci lines further down at 107.75 and 104.5, but I'm not sure how good these are. The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low at 83.75, and the early February low at 81.75, end of quote. I continued further, and is an important piece I dealt with, it is important, and I quote, the only feature to consider is a new one I have drawn on my weekly chart, which is not as yet established, but which deserves consideration. It is the April to date descending wedge pattern, and that's currently 93 even to 130.25. This is still a nascent pattern, but one worth watching, end of quote. Last week we were approximately midway between the dark blue highlighted upper and lower trend lines for this pattern. This week, well, we are today testing the lower trend line, and this descending wedge pattern is no longer a nascent pattern, but the main pattern for this market now. The key feature to watch for, apart from the obvious breakout of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top, and that's currently at 76.75. This will be approximately during the week ending the 22nd of November this year.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.